Welcome to the Great Report, a special live edition. Thank you for taking your time this Friday afternoon. Special guest host Blake Pieroni, who's the head of investor relations here at Great Capital, joining us today to talk through some of the bigger issues in the multifamily industry. But even more exciting than that, talking about the experience that he's just gone through. I've just gone through something that we do all the time here at Great Capital, and that is, raising capital for multifamily investors from family offices, high net worth individuals, and even institutions. Blake is incredible at what he does. He's a key member here, a team member at Great Capital. And he's also got a really interesting backstory. He's got maybe a couple gold medals. He's swam a couple times, although he would tell you he's not a swimmer anymore. And frankly, it's not necessarily, not that you don't like talking about it, Blake.
No, it's not that.
But it's oftentimes it's a distraction from talking about multifamily.
Yeah.
Right?
Yeah, exactly.
But thanks for coming back on the show.
Yeah, thanks for having me.
You're not a stranger to this room.
No.
A lot of investors at Great Capital seen you through this lens. Because if you're a prospective Great Capital investor, you schedule a meeting with us. If this room is available, it's kind of like the best room to have a video call. And so a lot of our investors, prospects see you and Griffin or me or anybody on the team kind of from this vantage point.
Yes.
So, but you haven't been on the Great Report podcast in a while.
I have not.
So just taking a step back from your vantage point, we'll start really high level. I want to get into some of the news and reports, and then get into some of more of your experience. But skipping ahead a little bit, I'm just curious of what you're taking a temperature on how you feel up on the multifamily market right now.
Temperature check for multifamily. I think it's such a mixed bag. You can't do one temperature across the board. Yeah. I think like real estate's always been hyper local, but I think even more so now it's like extremely local. Like a lot of the markets in the Midwest, like Indianapolis or Columbus, we're like super bullish on. Like valuations are down. We think now's the time to buy. And there's some other markets that, we wouldn't even look at deals there. They paid us to buy them. It's just such a mixed bag because, investors are kind of wishy-washy and a lot of uncertainty from them. A lot of debt questions, negative rent growth in some areas, positive in some others.
Yeah.
Expenses, some like actually insurance maybe coming back a little bit, property taxes still going up, but insurance already had like a big run up and now it's pulling back a little bit. I don't know. It's just like it's a wishy-washy market in general.
Confusing.
Yeah.
And that probably goes to, it's also true for the broader market, not just multifamily. If we zoom out a little bit, talking to just anybody, it's hard to make sense of where we are with tariffs, uncertainty, geopolitics.
Yeah.
It's an interesting point. Potentially interest rates are going to be coming down in September. But you mentioned markets, and it's so true. And it was the good answer because every market's different. Every submarket is different. And when we're telling the story of like an Austin, Texas versus a Columbus, Ohio, or a San Francisco, they couldn't be more different. So getting to RealPage, this report that came out, it was interesting. This was the most clicked article on the Great Report newsletter, which you can go sign up at greatcapitalllc.com. I think it's the best multifamily newsletter that's out there. But it's 10 U.S. apartment markets set to see deliveries increase next year. We've seen so many articles about how supply is getting ready to fall off a cliff.
Yeah.
Again, if you just look at the national numbers, that's true. And in many markets it is. But there are some markets that are still adding supply. So, we're looking at this chart right here. This is the U.S. national, annual apartment supply scheduled to drop off. It already started dropping off kind of end of last year of 24. We've seen markets like Indianapolis. There's almost like a 50% year over year decrease in potential new apartment supply coming online. But then there's some markets.
Can I tell you the one that surprises me?
Yeah. So we're looking at this list.
Yeah.
Looking at and some people are watching on YouTube. Well, everyone's watching on YouTube right now. Later, there's going to be some folks that'll be listening on the podcast. What on this chart? What on this list surprises you?
I would say Cincinnati.
Yeah.
Yeah.
And so Cincinnati is, number 1, 2, 3, 4, 5 on the list. They are seeing a 47.4% annual supply increase. And now that's year over year increase. So it's not like there's going to be 50% more apartments in Cincinnati. They're just building 50% more than they delivered last year. And so they basically delivered about 2,100 in 25, or that's supply for year end at the second quarter of 25. They're scheduled to complete by the second quarter of 2026, 3,100 apartment units, increasing that count by basically 1,000 year over year. And part of that could just be kind of the local timing of that. Maybe there was a supply. We'd have to drill down into Cincinnati to
Tougher
see if
permitting.
could have been tougher permitting, or maybe that there was a slightly lack of supply, in 2023, and then it's just a little bit of a delay,
a little bit of a lag
when those units came online. And that's, again, it's a great example of every market tells a little bit of a different story. I mean, Los Angeles, you brought this up before we press play. I mean, Los Angeles is seeing a 93, almost 94% increase from last year, going from 8,000 last year to 8,000 this year to projected 15,000 next year. But that's its own unique story. I mean, that has to be regulatory burdens, and other political issues in Los Angeles, a lack of capital. But that's a big number to post.
Yeah. Dallas has been the city that I have heard from more LPs in the past few months, where it's just the amount of supply that they're dumping into that market. I wonder if Los Angeles is going to be the Dallas next year.
Could be.
Where, GPs are getting crushed by a lot, super heavy negative rent growth in that market.
Yeah.
Interesting.
Yeah, and I'd have to look at what's not on this, which would be a helpful metric that we just don't have right in front of us right now, but just what that percentage of existing inventory is. Because Los Angeles is such a big market. And so 15,000 units is a lot of units, but for Los Angeles,
relative.
I don't necessarily think it's that many units compared to Los Angeles.
Right.
New York City, for example, is delivering 25,000 units.
Yeah.
That's not a huge increase from last year, but it is increase from this year to next year. It's about a 1,200 unit increase. So to me, it has to be a regulatory shift, and somebody probably knows in the comments. They can drop it down in the chat or tell us later they've all figured it out. But we don't really pay attention to Los Angeles multifamily too closely. Also, Detroit's on the list. To me, I can understand that a little bit more, just because it's been lagging behind. A lot of investors are be a little scared of Detroit because there's some areas you probably don't want to invest in. You don't want to catch a falling knife, but there's also some really great growth stories around Detroit, some suburban Detroit opportunities. I think some urban Detroit opportunities, but you just have to be really specific on where in Detroit.
Yeah, hyper local. Yeah.
Hyper local. But if you talk to anybody that's in Detroit, they'll tell you all the really exciting things that are going on. San Diego, a lot of California, San Diego, Anaheim, mentioned Cincinnati. Fort Worth. Dallas isn't on this list, but Fort Worth is on this list. They're still adding supply. We were just at an investment conference this week in New York City. I'm talking to some, Dallas, focused investors and some Texas focused investors, and man, they are really hoping that supply.
They didn't
gets
read
absorbed.
This article.
Exactly. Again, you would hope to think. Even like Indianapolis, where we're not oversupplied to the extent that Dallas is and other markets, but we saw more supply than we've seen in a long time. And so when we see an article that our deliveries are going to come down by 50%, that's got us feeling pretty good.
Yeah, and we saw some headwinds from the supply that we had.
Yeah,
nothing.
For sure.
I just can't imagine being a sponsor and focused in Dallas and Houston, Austin.
I can't imagine.
Can
you imagine? Again, our portfolio, not to
Did anyone project negative 4% rent growth on their performance?
You're active in our underwriting models. You know what negative rent growth does to pro forma. It ruins it.
Yeah.
But there's just no way you can get out ahead and get a positive real rate of return if you have negative revenue growth. Exactly. And your expenses are going up.
Exactly. I guess you could just kind of hope you're more so in B class stuff, because hopefully a lot of the new supply is A, luxury A+, and maybe not competing with you as much.
I think that the hard part, though, is what we've seen is that it's trickled down to B class apartments also. I think that's one of the interesting phenomenon or facts that we've learned over this last couple of years is that new supply, even if it is Class A inventory, ends up trickling down to B and even C class because, especially when those A class units are competitive to be leased up, they're lowering the
drop the
rents,
rents.
they give concessions, and all of a sudden they're competitive compared to the B class properties. I mean, an extreme example, it's not exactly a perfect analogy, but like what we experienced with Echo Park and Hayden.
Yeah.
Echo Park is kind of like an A minus. Hayden comes in, which this is Echo Park's one of our properties in Bloomington, Indiana, and then there's a competing property down the street that was brand new, really nice, basically a decade newer. And they lowered their rents to match our site. And so, like, how do you compete?
I guess if you were there was such a big gap where, if you were $500 cheaper or everything coming in was $2,500 and you were at $1,800, maybe you would feel a little bit of confidence in that to where hopefully most of it.
True.
But it's kind of, hope and a dream, I guess.
And I think that there is insulation when there's not so much inventory.
Right.
Because when there's like a few new properties coming online, they don't have to be as aggressive.
Yeah.
And so you can maintain the spread of your B-class apartment communities.
Right.
But when so much inventory comes online and no one can lease up anything, managers and owners get desperate and just because they're trying to lease up to get out of that construction loan as quickly as possible.
Yeah. If I was an LP and I saw a deal in any of these cities with any sort of moderate rent growth, I would, heavily question it.
Yeah. Yeah, I agree. Although, again, I think each one, there's just nuance to each one. I mean, I don't think just like year over year supply increase tells
at least in the first
story.
2 years.
Again, I'd want to see, relative to the existing inventory.
Yeah.
And just lining in where, and then certain submarkets are going to be different.
Yeah.
Like some markets on here that I like. I mean, I do like Cincinnati. Pittsburgh, I think, is an interesting market. We're not actively pursuing any deals in Pittsburgh, but it's got some interesting fundamentals. It has a lot of I hear it more and more being like lumped into Midwest. Although when I think of Pittsburgh, it's like definitely like a Northeast because it's in Pennsylvania, but it's obviously Western.
Yeah,
Western like part of Pennsylvania. And then a lot of these, I mean, are your kind of Northeast primary markets: New York, Boston. Newark, throw that in with New York, San Diego, Los Angeles.
Yeah.
So it'll be interesting.
And so while these are only 10, article is saying all of the others are having decreases.
Yeah. Exactly. These are the outliers. Right. The rest of the market, I mean, this is the rest. This is the average or aggregate of the market right now.
Right.
As they are continuing to slide down. But sticking on just kind of national market fundamentals, and again, the theme of a lot of these reports are in their national reports, and there's a lot of like local nuance. Here, I'm going to switch here. Is there was CoStar came out with, well, technically it was apartments.com, which is wholly owned by CoStar Group, came out with a report for August for their multifamily rent growth report. And essentially, U.S. apartment rents declined in August, with the national rent falling to $1,713, a 0.23% decrease from July's revised rent of $1,719. Now, if you're a Gray Report newsletter subscriber, you probably also saw the Yardi report, which showed a slightly smaller decline in August. It was like $1 on average. They're showing basically like a $6 on average decrease. You could say that it's flat, but the fact that we're in August, which is typically the period where you start seeing rents like slow down, but very rarely do rents go negative in August in the summer. Typically, like the only time we see negative rent growth, at least on a national basis, is like December and January.
Yeah. So maybe as an indicator for the rest of the year, kind of question mark.
Yeah, I mean,
it's already coming this early.
If it's already flat, and so it's. And we talked about this on the show last week with Jay, trying to really understand what this is. Is it how much of it is it economic uncertainty, people just not wanting to make a decision? How much of it is just the perception that rents are high elsewhere, so I want to stay put because our renewal rates are very high, and then how much of it is just the new competition?
Yeah,
we've just brought on a ton of new supply, so there's just a lot of new competition.
Yeah.
And they're that overhang of owners lowering rents to solve for occupancy, giving concessions, giving deals, and that's all just trickling down to just a softer market.
Right. I think that's the hardest thing with everything right now is you don't have one answer that it kind of explains everything.
Yeah.
It's like all of these different factors weigh in, and they all weigh in at different weights or amounts, and it all kind of contributes to whatever we're seeing here, slight decreases, but at different times in the year they might be moving. Now this is contributing more. Now interest rates are contributing more. Now supply is contributing more to the overall picture. And it's like, it's pretty dynamic, and it's kind of, it makes it difficult from like an LP standpoint, I think, to kind of make sense of, I don't know if it's super helpful to kind of make sense of the national market.
Yeah.
At least for our standpoint.
I usually tend to agree, but then there are some things that there's trends that are national, again, because we've seen like the slowdown. Like, we still have positive rent growth in our portfolio.
Yeah.
I mean, I think like we're growing rents by just below 6% on average.
Yeah.
But still, when I look at lease traffic, our lease traffic is way down this summer. And it wasn't just August. It was really kind of like June, July, and August. I mean, we signed a third of the leases in August than we did in May. So like, we should be signing less leases in August than May, but it shouldn't necessarily be a third.
Right.
And that lines up, our portfolio, call it the anecdote, but that lines up with a lot of the national numbers that we're seeing.
Right.
And so that tells me maybe it's something more than just like our local dynamics.
Right.
And is there some psychology that is, having renters not want to go out and sign a new lease, just not want to take that action? And it's kind of a similar scenario that we experienced back in, really kind of 2022 and 2023 when interest rates started to be rising.
Right.
And it created just so much uncertainty.
Right.
People just didn't want to make
Decisions.
large economic decisions because they didn't want to get hurt by it.
Right.
That's the only thing I guess I can think of. But it's also strange to think of like a renter being like, I'm not going to rent an apartment because of the tariffs.
Yeah. Yeah. I don't know. I wonder if just people like just want to move less in general. Maybe everyone's made their moves from like the COVID pandemic, and they're like, this is, where I'm at now. I don't need to move anymore. Or I don't know. That would more so be, people moving from like California to Florida or something, not like within a small market, Indy to Greenwood or something.
Yeah.
But I don't know. It's interesting.
On the topic of uncertainty, and we're going to get into this later, what are investors, where are they in, the realm of uncertainty? I mean, clearly there's enough that are able to make decisions. We just completed the capital raise. We're finishing up a capital raise. So there's enough confidence in the market, but are investors confident when you're talking to them, or are they unsure?
Again, it's a complete mixed bag. There are some investors that, look at our deal and they're like on their, we've had two investors say that they've had more capital calls than they've had distributions this year. Wow. But they invested in our deal. So some are like, not to say used to it, but like kind of either written some other investments down to zero, have kind of moved on with it. Others are just in a really good spot and like picked really good deals from 2021 and picked really good markets and did, maybe fewer deals, but a lot of due diligence on the sponsors. And they're like kind of like completely bypassing all the stuff that's happening in Texas or, a lot of the other markets where there's a lot of headwinds and negative rent growth, and they're not really even feeling it in their own portfolios. Yeah. And it's a total mixed bag. In general, if I do try to paint with a broad brush, it's harder to raise equity. Because other deals aren't doing as well. And so people are like, I've gotten 24% in the S&P 500 or whatever the last 2 years. Yeah. And the two deals that I invested in real estate in Texas are both not distributing. Yeah. Like I'm done with this for a while. Yeah. That kind of thing. That's definitely there. That's not everybody. In general, what are they looking for? After going through a lot of this, I think the number one thing that they're looking for is like day one yield without like a huge lift. It's like a smaller margin from what the property is currently doing to what you're saying you can make it do, making that delta more narrow and reasonable assumptions.
So less speculation.
Yeah, less speculation by far.
Yeah, kind of a simple business plan, something you can quantify. You don't need a lot of different variables to go right.
How certain am I that you can give me 6% cash on cash or 7% cash on cash? And they're not as focused on total return.
Yeah. And you have seen that more focus on cash yield rather than IRR.
Definitely. Definitely.
We're jumping ahead a little bit, but what kind of cash on cash people look for, you think, today?
I think over like a 7-year period or a 5-year period, 7% cash on cash is really like the number that investors want to see.
Yeah.
And one of the most challenging things from this capital raise, at least from my seat, is I don't want to, again, painting with a broad brush, but some investors don't weight the cash on cash or IRRs relative to the risk. And I think it's kind of interesting on the past 3 deals that we've done, River Club, Solana, and Flats, they're kind of stepping down a little bit in risk.
Yeah.
And, some investors want heavy value adds and want to go for an 18, 19, 20 IRR. Some want to do flats and want, 7% cash on cash with reasonable assumptions and don't want a huge lift. And, every deal that we do isn't going to be perfect for what everyone's looking for. And I think that's okay. It's just like presenting why we think this one is such a good deal. And it is because of like, it's a lower lift.
Yeah.
If that makes sense.
Yeah.
So.
All right, I'm going to ask you about all of that here in just a second. I'm going to ask you about flats. I'm going to ask you about Solana, and I'm going to ask you about River Club. Those are the last 3 deals that we did, and just kind of the difference between some of those raises. Just to finish up though on this last piece. Now this is from we had a inflation print this week, Blake. If you weren't aware, we were together, so because we were talking about it. I had a run up. From our hotel to drop it in the newsletter.
Yes.
Because how could we put out a newsletter on macroeconomic data? The newsletter goes out at 8:30. The CPI print is at 8:30. I'm like, well, I'm not gonna. Why would I send it out at 8:30 when it's going to be out of date? So it went out like at 9 this week. Apologies. Usually we're right on like clockwork. But we had CPI for all items rose 0.4% in August. And a rose 2.9% over the last 12 months, not seasonally adjusted. So on first blush, headline 2.9%, it's below 3%, but it's way above, the Fed's target of 2% inflation.
Yeah, it doesn't seem like it's going in the right direction.
So that's the headline. But okay, so this is where I'll push back.
Yeah.
A third, again, and listener to the report, this, a third of CPI is shelter.
Yeah.
What have we just? We were just talking about
going down,
but it hasn't gone down once.
Right.
Shelter has remained positive growth. Rents, according to CPI, have been positive.
They're just typing random numbers. I
don't think that. I think that the methods that they're using just aren't the most accurate.
Yeah.
We have been talking about this on the Gray Report for the last 6-9 months. Honestly, probably a year and a half.
Yeah.
Of how this doesn't make sense how CPI is being calculated. Finally, folks in the Trump administration are starting to pay attention. I don't know if they're subscribed to the Gray Report or not. I don't know if Jerome Powell subscribed to the Gray Report. I can't tell you. I can't tell you that they're not subscribed to the Gray Report, Blake. But it doesn't make any sense. So there's been major pushback. Here, sorry, I was going to the right article. There is now the Labor Department watchdog. It's opening a probe of BLS jobs, inflation data collection. And again, I'm not saying there's no conspiracy that I think exists. There's no we're going to manipulate the numbers. No, if you wanted an outcome, you wanted to manipulate the numbers, it'd be an interesting way to do it. And it doesn't seem to be that hard. But I'm just saying the methods that they're using are outdated. They haven't been reevaluated. There's been no push to do it. But
are you saying that our government isn't doing a good job on publishing some of this data?
Definitely not. They're not doing a good job. And what it comes down to is that the Federal Reserve, who controls monetary policy, controls the price of money through the Fed funds rate, is, as they've said, being data dependent. We're going to look at the data. When the data changes, we'll reevaluate. We're just going to look at the data, and we're going to look at our data specifically, government data from the BLS. And we're aware of private market data, but we're going to use, whether it's the PCE or CPI to make those calls. Census data, BLS data. Well, it's all really clear now that data is inaccurate.
Yeah.
Economists from across industries, across the political spectrum have said we really need to evaluate the way that we're collecting this data, evaluate how we're putting it out there.
Yeah.
And so if we're using bad data, make decisions. It's like garbage in, garbage out.
Yeah.
And
it's something as important as the Fed, and monetary policy. Can you think of something you would want more accurate right data for?
And the reason why we've been talking about this so much on this show is because we're living it day in and day out.
Yeah.
I mean, one, we're in the industry, so like we're seeing rents. Now in the Midwest, rents are positive, but we're also tracking rents across the country. We do the show, we put out research reports, we do our own research, we're aggregating research. We're doing our John Chapman. He's doing our own forecasting for us ourselves. So we're pretty close to this, and then we see that the government data is saying rents are still positive, and we know objectively that is not true. It begs into question:
should we blindly just believe what they're saying? Is that the question you're going to ask me?
No, I guess what I'm saying, but your reaction to it looks like we're going in the wrong direction.
Yeah,
is what a lot of the headlines are saying.
Yeah,
but if you strip shelter out, if you bring shelter to zero, inflation is at like 2%.
Yeah.
I'm not saying that there could be pockets of inflation here and there, and tariffs might not be inflationary, but I'm not even saying that like we absolutely should lower interest rates. Like probably that would be appropriate. I'm honestly more in the camp that like a recession wouldn't be a bad thing to like clear out the system, because all of these real estate deals, all these multifamily, office, private equity deals. Yeah. There's a lot of like bad business decisions that have been rewarded and bailed out.
I think there's a little too many fingers on the scales for people that have taken the risk or, not necessarily, done everything correctly. And they're just kind of being, whether banks, lenders, the Fed cutting rates or whatever. Yeah.
So how does it make you feel? You're trying to raise money, and you're trying to raise money for great capital. You're trying to sell our track record, which we're proud of. We're in the Midwest. Then you talk to investors who are investing with operators, syndicators, who seemingly are in deals that are going under, but like they're not really feeling any of the pain because they've had their loans extended, pretended, and now maybe a little bit of a bailout. I don't think it's going to save too many folks, but like if the Fed funds rate does come down 50 basis points, that might be the difference between a percentage of deals that are able to be saved or not.
Yeah.
And again, screw fairness, but like, how does that make you feel? Is that right?
Earlier, maybe like beginning of this year, it was like kind of made me a little upset, pretty angry. Now, I think a lot of the investors in these deals kind of realize that, if they haven't heard from their GP or the deal isn't going well, or like this deal is kind of done and toast and nothing can save it. And I think like investors have like come around a little bit more, at least on this raise. It was like, a little bit more reasonable, I think, on this point. But earlier we had a deal, February or earlier this year. And that was my biggest issue, is like, oh, but all of these deals, blah, 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 these assumptions. And I'm like, yeah, but these are more reasonable. And this is like a good deal. And it's, and so that was kind of hard to deal with.
So what is it like if someone's saying, you guys are projecting positive rent growth? How are you doing that? Because rents are negative. My perception is from a bunch of Texas deals. How do you
Yeah, the good thing is they're not. I mean, most investors aren't like argumentative about it. They're coming into it with like an open mind, and it's a genuine question. And it's kind of an easy answer. Like our existing portfolio is well over 3%, and to show rent growth, and like again, it's hyper local.
Yeah.
And so I think it's an easy answer, and most investors aren't coming into it with like, this is an absolute ridiculous assumption. They're asking like, how do you feel comfortable with this?
Yeah.
And they're open minded about it, and so it doesn't really
It's rare that an investor is going to come into a meeting who's ready to ready to debate.
No,
right?
Yeah, they're busy. No one has time to why hop on a call if you want to
Exactly. Well, what's one of your, tell us about maybe one more difficult LP calls that you can think of.
One of the more difficult LP calls. Well, in general, the most difficult thing to deal with in an LP is when we have a good call. And, end the call with like, let me dig into this a little bit more. And then I don't hear anything for weeks.
Yeah.
Follow up, don't hear anything. I would rather you tell me no and say why than not tell me anything for a long week. Cause like it's taken up time for the hundreds of other emails that I have to send, and talk to people from. That's one of the most difficult things. But in terms of like assumptions, this one, like I said, like this one wasn't as bad as like some other raises that we've done.
Did you find that? So we had a deal earlier this year. We ended up backing out of.
Yeah.
found some things in due diligence, some issues with the loan we were going to assume, just couldn't do the deal.
Yeah.
Backed out. We lost some money. All investors didn't lose money, just
Right.
some pursuit costs. All's good. I guess compare that deal and also the environment. I guess the timing.
Yeah, night and day different.
What was the difference?
Well, part of it was the deal, part of it was the market, and part of it was timing again. Like, there's not one thing, but I mean, the negative leverage, there was way more supply coming into that area. We thought that it was being absorbed really quick, and then similar to a lot of the other markets where the supply is coming down, that's kind of why we felt pretty comfortable in it. And talk about hyper locality. I mean, this property in that submarket was like right in front of the walking path that got like the most traffic to Louisville.
Yeah.
And so we thought, geographically it was a really good deal, but like, I don't know this for sure, but I think that might have been the absolute peak of capital calls for LPs and other deals as well, because they were like, how dare you come out with a deal that's negatively levered showing rent growth? I just got four.
That was February, March of this year.
Yes.
Yeah. So you think that was the peak of
timing.
Capital calls, at least from you hearing about investors getting hit with capital calls?
Yeah, I guess we weren't raising like entirely from January to now, so it's hard to say, but significantly more I was hearing it on that raise than this one. I mean, I was still hearing it a little bit on this one that, don't have liquidity at this point, keeping money back for other deals.
And what do you tell a prospective investor or current investor who tells you like, hey, I'm facing a capital call right now. I like this deal. And then they may even be asking you, which they have, of like, hey, should I even like do this other capital call?
Yeah, it's a tough situation. I mean, it's sad. Like, you're putting money into other deals. Like, you don't want anyone to lose money regardless of what deal it's in. And, sometimes it's a significant amount of money. Some people went heavier in other deals, but I usually offer to like look at that deal if they are asking questions about their capital call. But I also I'm not going to like press them to invest in our deal because, I don't want them to get into like a tight cash flow situation or anything like that. So usually I just offer to, help analyze the capital call that they are receiving if they would like us to, and give our 2 cents. But yeah.
Have you talked to many investors who have told you that they're just, they're done investing in real estate? Like, look, I invested a bunch of money with syndicators over the last couple of years. It didn't work out. I'm out. And maybe we never had those calls because they were out. They didn't want to engage with us. But any of that sentiment?
I haven't had any that said they're done forever. I have had some where they're like, I'm done for a couple of years. We've had some family offices that have been extremely allocated and are like, we're waiting for some of this capital to turn over. Not that their deals are going bad per se, but they're like, we put it all out and the hold periods have been extended to, what was going to be 5 and now we're in year 8 or something. And so I'm hearing that a lot more.
What is it like working with family offices? Any differences raising capital from family offices versus, high net worth?
It depends. It depends on the family office. I think it's a little bit easier from a family office because they're like, send me the numbers, let me look into things. And then they come to the call with like 4 main questions and they're very familiar with the process and very familiar with the structure. And so there's not any kind of education on maybe like, some different structure or pref or, different fees or anything like that. So it's really just talking about the deal and why we feel comfortable with the assumptions. From my standpoint, that's a lot easier.
They're more educated. They come in some pretty sophisticated and or organized.
Yeah, been through around the block, and usually there's like 1 or 2 things that is a little sticky for them. Yeah. That they're like, I don't know about this assumption, or whatever, or what if can you show me a refi? Show me what what refi sensitivity you could refi at to where you would not be able to cash out any money or have like a neutral refi, or they want to see something in addition that would be some sort of a stress test. Yeah. Which we're happy to do. Yeah. And we're trying to put more and more of that in our investment decks, but trying not to make them 100 pages.
Yeah. What's the best method to, communicate a deal to an investor? I mean, there's decks, there's webinars, there's videos, there's calls. What's like the most? What have you found being the most efficient way to kind of get investor up to speed on a deal?
I think a deal video of you or somebody talking about the deal, listening to that, whether they're in the, LPs are busy, in the car, or mowing the yard, or doing whatever, listening to it so that they just are familiar with the deal, and then hopping on a call and asking, something about the debt, something about whatever.
So that is like, in our mind, that avoids like having to do a whole pitch in a presentation and really kind of eliminates a call often, right?
Yeah, and
Because
it
like you have
saves
to,
them time as well.
yeah,
It's like you can do it while you're doing something else.
yeah,
And if you listen to the whole thing, it'll probably answer a lot of your questions. And you don't have to read a 52-page document or whatever, or go through you can go through the PPM and everything. But like, hopefully most of the questions, or I think you do a good job of answering a lot of the questions, kind of before they happen. And then coming onto the call with, a good understanding of the project, and then, asking.
yeah.
Yeah.
I think that's probably one of the biggest improvements to kind of our fundraising process over the, I don't know when we started doing that, probably a year and a half ago or so.
Yeah.
Because it basically eliminates, a third of the kind of calls we have to do
Yeah.
with a prospective investor.
Exactly. And I think it also eliminates some of the potential, not bad meetings, but the deal wouldn't be a good fit for some investors.
Yeah,
You know
yeah,
what I
yeah.
mean? That was like, oh, Great Capital has another deal. I like some of their deals. But, if some family office or a group or LP is looking for heavy value add 19, 20 plus IRR, and then they listen to a deal video that you did on flats and it's a core plus deal, they're like, okay, not for me on this one.
Yeah.
And they don't have to schedule a meeting, look through the thing and then ask me a bunch of questions and realize that this isn't the deal that they're looking for.
Yeah. So like a lot of investors, will say, I'm looking for returns of, 20+%, 21, 22% IRRs, or maybe they've seen some AAR returns and have been confused, but they're looking for returns that are above the rates of returns that we would typically show
Yeah.
an investor.
Yeah.
I'm looking for really strong, 10% cash on cash and 22%, IRRs. How do you still continue that conversation with that investor when that we're never going to show them a deal that is at least pro forma to that high of return? Maybe our sensitivity analysis can show you how we can get there, but
Yeah.
I mean,
I would just say, like, if they've seen our track record, all of the deals that say 20 to 30 IRR were never projected at a 20 to 30 IRR when they were initially kind of pitched and before they closed. Everything was between, I don't know, 14 to 19, 14 to 18, something in that range. I don't know. For me, if I see a deal that says like 22 IRR, it's like a red flag.
Yeah.
It's like immediately I immediately think that some assumption is out of whack.
And then do also you give people that are kind of lump all multifamily investments together of like, well, I saw this one multifamily deal at a 22% IRR, but maybe it was a development deal, maybe it was a heavy value add, or maybe that it was a 3-year hold, a short-term hold versus a 5 or 10-year hold, because just the same exact deal held for 3 years versus 10 years from an IRR basis, assuming that the financing is the same, like the 3-year hold is going to be significantly higher, but your multiple may be like 1.3 over 3 years, where the 10-year hold, maybe you get like a 3x.
Yeah, not as much of that, but actually going back to the family office real quick, one thing that is slightly different between like retail accredited and family office is like some family offices will look for a 19 IRR, but they recognize that the risk to achieve a 19 is going to be greater, and they're okay with that.
Yeah.
Sometimes LPs will look at it and be like, it's higher number, better deal, higher IRR is better. All deals are risky and they're all the same. And like, no, not even close. That's a multifamily deal. It's all the same.
Yeah, multifamily is multifamily. We're going to buy something that's 40% occupied, that's bombed out, and we're getting an 18 IRR. But your corp deal that's 95% occupied and growing suburb is only a 15 IRR.
Yeah, and I think what we're going through right now on the LP side, I think that is changing all of this slowly. They're like, okay, like, a value add deal, floating rate debt in Dallas, Texas right now is not the same as a core plus deal in Indianapolis or Columbus, fixed rate financing. Even if the IRR is 200 bips higher, maybe not worth it.
Yeah.
Some people it's like, it's worth it. I want the highest return and I want to swing for the fences.
Yeah,
and that's fine as long as you like recognize that you're taking that extra risk to get that extra projection.
Yeah. And some investors definitely do.
Yeah.
So we were just in, we were just in New York City, got back yesterday. We were at a conference, the Carmo Company's U.S. Real Estate Meeting East. Really, it was great event. A lot of family offices, some institutions were there. It wasn't their first time going to an event like that by any means, but what's it like going to, going to another city, raising capital? and being at one of those like investment conferences. Kind of just what was your take coming back from it?
In general, it was good. I liked this one even more because we got to tag on our investor kind of meetup.
Yeah.
So the day before the conference, we got to have a dinner with I think 12 of our investors that are in like the New York, New Jersey areas.
Yeah, it was great.
That was great because I always like to get FaceTime with our investors. But the conference itself I thought it was good. I've never gone to a conference where I was like, that was the best thing I've ever attended.
Yeah.
It's like, it's very interesting and it's
Yeah.
good to like talk with other people in the industry. I thought it was interesting and cool that the Midwest got mentioned a lot more than some of the other conferences that we go to. In the past, Midwest is like considered sleepy and boring and not sexy.
Yeah,
And it got
often
mentioned.
just doesn't get mentioned at all.
You know how like in quarterly investor reports or publicly traded companies, they kind of track the number of terms that a CEO will like say.
Yeah.
And it was like, how many times did they mention AI?
Yeah,
And like
exactly.
now they're like not mentioning AI as much.
Uh-huh.
Midwest is being mentioned more.
Yeah.
Yeah.
Yeah. That's
And
that's
so-
good. That's a good point.
Yeah.
What I mean, do you think what are the challenges of some of those conferences? Because they're not perfect.
There's a lot of challenges. From the LP side, I would have to imagine that you are going to this conference knowing that you're there to be sold by a lot of GPs, and every GP is going to say that they underwrite conservatively and have the great deal and have the great strategy.
Yeah.
And it's got to be really hard to like just do the manual work of like sifting through all of that, unless you have like a really big company and you have all kinds of analysts that like who should we actually deploy capital
Yeah.
with, and like going into extensive research on their track record. That would be very difficult.
How do you stand out? How do we stand out? Because I'll get to the second point, but hey, how does one stand out at a conference like that?
One thing is, I don't think we try to stand out like very aggressively. I think sometimes when either a group or a person's like, hey, look at me, look at all this great stuff that I'm doing, and
Yeah.
like overly marketing and
Yeah.
overly, I just don't think it's the best thing ever. I don't think that we do that, but sometimes we try to you were on a panel where you gave a good talk about the kind of state of multifamily. I think that was pretty good. I think it was well received. A lot of the LPs in the room came up to us and said that they thought your talk was very good. But it is not easy. I mean, we're kind of in a sea of GPs out there.
Yeah.
So
The one thing I did notice this was the second point. From previous years of going to that specific meeting conference and just other kind of either private wealth, RIA, investment, family office, and many of them real estate focused, but not necessarily all. So many of them, especially the real estate focused, but just the general ones as well. So many GPs, specifically multifamily GPs. And I saw a fraction of multifamily GPs this year compared to last year.
Yeah.
And I'm just wondering, is that because, the herd has been thinned a little bit already? Everyone's in kind of like protect mode.
Right.
I'm trying to figure out these capital calls, and like I'm not going to go and I'm not raising money for my new next
Right.
deal right here. I'm just worried about saving the deals I already have. Or is it a pure, money is tight? It's not, this is a business that, the true profit for a GP can be 3, 5, 7, 10 years down the road when you sell.
Yeah.
And so you have recurring revenue coming in. You're often not able to cover all of your operating, overhead, especially if you're growing. And so, and these conferences aren't cheap. I mean, it can be a couple $1,000s a ticket up to, tens of thousands of dollars for, sponsorship slot, or some are tens of thousands of dollars even to go for a couple meetings.
Yeah.
With the hopes and no guarantee that you'll actually close an investor.
Right.
So it's a major investment, and I just don't see that the excess cash floating around of people spending that money to go raise for.
Yeah, I thought that was pretty interesting. It was pretty diverse in terms of the real estate GPs that were there. One of the other things, just to go back a little bit, that I think is more interesting that is somewhat of a trend right now is for this deal in particular, and a few people that we met there, we got way more referrals, or are starting to get more referrals, whether it's family offices or other investors. I don't know if it's just you get a certain amount of investors and they have a certain amount of contacts and network, and they like us and talk positively about us, but it's becoming more and more common where we go to a conference and people are like, oh, I've heard of you before, like one of my friends invests with you, or this family office said good things, or we had an investor on this deal that one of the larger investors said, like, I've done a few deals with them. I really like those guys. And, one of the prospective investors had a 1031 that, he was heavily considering. Timing didn't work out for this one, but, heavily considering investing. And that is becoming much more common for us.
Yeah. The referral.
Yeah. And the kind of network effect.
Yeah. I remember that investor mentioned at our dinner that, he had read a lot of good things about us online, which I thought was interesting because I'm like, it's great to hear, but I don't know exactly where all these communications are going. I think it was on a private forum.
Yeah.
But Reddit. I mean, it's really good to hear. Yeah. Well, I don't think,
Do we have a Reddit subreddit?
No. We don't have a Great Capital subreddit.
No.
Unless you've made one.
No, I haven't made one.
No, Reddit deleted my pass from my account. I don't know. I have to reset it. Oh. They banned me because my account got hacked or something. I don't know. Inside baseball. What have you learned? I guess since you started a couple years ago, never raised capital. Curious about real estate. You're really into kind of personal finance. Mm-hmm. Prior. Jumped in, been able to do an incredible job, built a lot of great relationships. What are some of the big things that you, I guess, didn't know then that you've learned now?
Didn't know. Well, that's a long list of things that I didn't know then, know now. But
or something that's surprised you, or misconceptions.
Again, a lot, but the things that I've learned that are maybe some of the most important, and the things that we've heard from investors, is the transparency.
Yeah,
that is I don't know if that's on the wall somewhere in here. It's not. Probably should be.
Yeah.
But it's the number one thing that people say to us is communication and transparency is, even when maybe a deal is not on pro forma, you're letting me know, very quickly why it's not and the plan to get it back on, which seems like the industry standard for communication and transparency is really bad. Yeah. Maybe we just do a really good job, but
isn't it that strange? I feel like if you just are on LinkedIn, if you're, plugged into all the multifamily commercial real estate, syndicators on LinkedIn, it sounds like everybody is doing everything perfectly. Everyone communicates with their investors, but then, and we do what we think is the right thing to do, not necessarily doing anything above and beyond, but then investors tell us that we
right.
we communicate more than anybody. Right. And they're like, you guys actually tell us what's happening at the property.
Right.
And we're surprised because again, it's doesn't everybody else do this? But it is so much easier. And again, it's not just it's the right thing to do. It is the right thing to do, but practically it's so much easier.
Yeah.
Because how many questions do we typically get? If we send out a monthly report or a quarterly report, how many LPs either schedule a meeting or even send you an email asking questions?
Usually not too many, but it depends on the property. It depends on kind of the report.
And there could be an event or something happens and people have questions. But if we sent out quarterly reports, a couple, I don't know, maybe a month and a half ago or so.
Weeks ago.
Yeah, a couple weeks ago.
I probably had 4 or 5 questions across all of the properties.
Yeah.
It's not very much.
So it's less than a question per property on average.
Yeah. And by and large, it's to our benefit to do this, but sometimes it's to our detriment because doing monthly reporting and doing Solana, I don't know if you want to talk about Solana. And when we first took it over, we were occupancy's not good, not to where, where it should be, where we performed it to be. New applications have a 50% denial rate, all of these things.
Let's talk about Solana. So we closed a deal about a year ago in Indianapolis.
Yeah.
Beautiful, it was built in 2011, 2012. It's right on the river, kind of A- class. There's some really nice condos and townhomes that are 2,600 square feet, really nice. But the previous owner basically ran it into the ground right before we bought it.
Yeah.
And they let anybody in.
Yes.
We learned we had a couple due diligence lessons that we learned.
Let anybody in, wasn't fixing anything, really anything go with the property. Yeah.
I don't want to get into any legal trouble because it was kind of a legal thing for a while with the seller and some other parties. But just to summarize it, without getting into every single detail, we basically took it over. Occupancy dropped. We realized that the rent roll had just a ton of people on there that were not qualified to live there.
And fraud.
Ton of fraud.
Yeah.
Hadn't, there were people who had been waiting on an HVAC repair and replacement for months. Like
Yeah.
they'd gone the whole summer without air conditioning, like stuff that you're not even like allowed to do. And we step in, and everyone's like, "Well, we don't care that you guys are still. You're now all their problems are now your problems, and
Yeah.
just because they're not there, we're still,
Yeah.
we want them fixed, which is true. It's our responsibility. We've
Yeah.
got to get started, but that meant we had to spend a lot of money really quickly to fix all those problems. We had to, it was a public relations, battle. We had to, right size the rents. We had to right size occupancy. We had a ton of staff turnover at the beginning.
Yeah.
Pretty
amount of resources on the corporate side.
throwing tons of resources.
Yeah.
Of which, they're out of pocket on a lot of that stuff, because it's like we just got to get this thing, moving in the right direction.
Yeah.
So to walk me through that, because we do monthly reports. And so I think what you're getting at is that like sometimes like not a lot can happen in a month, but sometimes like a month snapshot can kind of be out of whack. Because you could have like a ton of expenses one month, and then the next month like very little expenses, and over a quarter, it averages out. And that's why we do like more robust quarterly reporting, but we do these like monthly updates, snapshot with like numbers. What's that? So what's that like when you're in the middle of that, and we have to tell everyone what's going on, being transparent.
Yeah.
So they're gonna find out eventually.
Oh yeah.
What's that like?
I mean, it's not fun, reporting something that we thought that this was going to happen. We're pretty sure that this was going to happen, and this is happening right now because of X, Y, and Z. But it's hard. And
you're not the one exactly like
doing it.
Doing the property management. You're just kind of you're reporting on it.
Yeah.
I mean, we got a property management team right next to you, but yeah.
Yeah, and it's kind of like everything's going to be okay. It's just like the first year, I'm trying to like say it's still a good deal. Like things are getting worked out, and I don't want to be like, everything's going to be okay. Everything's going to be okay. But that's kind of how I feel. It's like, it will be good. It's just like momentary difficulties,
Yeah.
We actually had an LP email us saying like they were looking through the numbers like heavily in the quarterly report. I think it's for Solana, but they were like, hey, you guys are doing a good job. Like it's totally fine with me if you just pause distributions to get everything figured out and the property doesn't bleed money.
Yeah.
And I was like, oh, that's nice of you to say. We didn't need to do that, but yeah. I was like,
most investors get it.
Yeah.
Most investors, I think some investors, I felt this way as an LP. You write that check, you're like, I might not get that back.
That sucks. I don't want that to be like the expectation. Though,
no, but like, you have to
minimize that.
But
chance.
you have to. You have to think of a worst case scenario.
Yeah.
And no, I don't want people to think that either, because it's like we have the exact opposite viewpoint of like you will get all of that money back, and we're going to double it for you.
Yeah.
And we are going to move heaven and earth to accomplish that.
Yeah.
Like no matter what.
Right.
But if you're on the other end of it, it's like, oh, I don't have control of, but that's what we have control. We're going to make that happen. As an LP, you don't have control. I think these guys can do it and they're the real deal, but I don't know.
Yeah.
And so
I think they usually feel comfort in like, you have a lot of money on this deal. You, meaning you. So they're like, Spencer has a lot of his own money in this deal. He wants it to go well. And you know what I mean? So I think that helps a lot.
I also think we've had a pretty good track record of like, okay, something's come up. We're going to tell you about it.
Yeah.
This is what we're going to do. And then we actually fix it.
Yeah.
And because like whether it's, Forest Ridge, a couple of years ago when, we were like, maybe we will have to issue a capital call because we did a big renovation.
Suncrest vandalism.
We had over 100 HVAC units vandalized, which we had to replace. And horrible.
Yeah.
Could have been, $600,000 hit.
Yeah.
Or occupancy issues at Echo Park. Or, we're dealing with some occupancy issues down at River Club right now, trying to get leased up. And but through all of those, we're still working on River Club. We need to get a couple more leases. But through all those examples, we've been able to create a plan to get us to where we want to go.
Right.
And so, that gives me confidence in our abilities as a team to say, like, here's the problem. What do we have to do to get ahead of it? And each time we learn more, so we can be more proactive rather than reactive.
Right.
I mean, like
we learned a lot from Solana.
I mean, even River Club we still need to get more leases, but we would be in a much worse situation if we hadn't identified that we needed to get on renewals well before just 90 days, because we had such a high concentration of renewals. If like, if we just got 50%, we'd be in a horrible position. We needed to get like 70% renewal rates,
Right.
Which is
a lot.
That's a lot. The
yeah,
average
for
is
the
like
team.
50%.
Yeah.
And there was a lot of transitions. We were trying to raise the rent. There were people who didn't like the color of paint. Like, you paint. Why did you paint it? We liked it when it looked like it was falling apart. So it was. But yeah, we were able to at least communicate it and move on.
Yeah, there's so much stuff going on. I just feel like the picture from the LP seat is so kind of murky right now and so difficult that it is hard to say this is happening and this is the path. So I feel like it is pretty difficult from the LP side, but I think our transparency communication gives a little bit of stability, saying that things are going okay or either getting better from wherever they are.
And then just to give you credit, Blake, you are really good at following up. So if somebody shoots a question over to us, usually there's a response like right away, and a pretty detailed response because we want to drill down on it, understand, and give you the information.
I would want that,
Yeah.
Yeah.
Someone asked a question, Blake, in the chat. How do you maintain and deepen relationships with repeat LPs?
It's a good question. Maintain and deepen relationships with LPs. I like to text a little bit more, like after you've invested for a first time, like text and say, hey, how are things going? X, Y, and Z, any questions on your Solana investment, any questions on your whatever.
Yeah.
And have meetings outside of when I'm
You have a
pitching
deal.
them deals.
Yeah.
Yeah. It's like, hey, have a meeting, come talk about River Club, have a meeting, come talk about Forest or whatever.
Yeah.
Which LPs are busy. They're like, I'm already in that deal, unless they're like very concerned or like, they usually don't do that. But yeah.
Well, I know we've had some success, like after the deal closes, reaching out to everybody also just to kind of make it's like, hey, the deal's closed. You're still going to hear from us. It's not like, you send your money in, we're gonna disappear.
And doing what we did this week, trying to meet up, have dinner, have lunch, meet them, have them come to the office, those kind of things.
Yeah. Or like we do a day at the track.
Yeah.
So like at the Indianapolis Motor Speedway right before the Indy 500, we usually get a suite and invite all of our existing investors, whether in town, out of town, to come in, hang out with us, watch some race cars, have some food, have some drinks. It's always a good time. We've done some other investor events. We don't like to do, I guess, a ton of investor events or like perspective or like education events, but like we'll bring in, folks that are already
that was a good question though. I didn't know we were taking questions.
Oh, yeah, always taking questions.
Taking questions?
Yeah, absolutely.
You can't answer them if you're not live though.
We are live.
I know, but you're not usually live.
We're not usually. I know it takes a little bit getting used to. The only other time we're usually live is, we did a webinar.
Yeah,
we're live for that. Right. But yeah, if anybody else that's watching has any questions, feel free to drop them in the chat. Any predictions on 2026 next year? Again, like because you got a crystal ball and everything, you've got it all figured out. What do you I don't know. What do you think next year's going to look like?
I don't know. I just, in general, I hope there's higher transaction volumes, just so we can see more deals.
Yeah.
Addison might not like that because he has to underwrite more deals, but
I think he'd be fine with that.
He'd be fine with that.
Yeah.
But I just want to see more deals and see a clearer picture
yeah.
of the deals that are trading, maybe the cap rates that they're trading at, or, you know, different, more data points, I guess.
Yeah. Yeah, I think everybody would like some more data points because, you know, the few data points are like the deals that have traded are either trading for like very surprisingly high valuations that are high quality deals, or it's a few deals that have been like a foreclosure, nobody wants, someone's picking up for pennies on the dollar, and even at that price, you're like, you know, good luck.
Yeah, exactly. Not much in the middle.
There's not been much in the middle, and so, but at some point, that problem has to be solved, and those deals need to transact.
Right.
Do you think so? There's different reports depending on who you ask. You know, cap rates are kind of stable, even coming down a little bit, or there's some folks that's saying, you know, I think, you know, cap rates might move up, prices might come down a little bit more before maybe prices go back up again.
Yeah.
You have a sense that when we see that volume come on the market, is it going to be prices going to be moving in the right direction, or?
I can't see them coming down too much more. I think there might be a slower growth maybe. But it seems like every prediction that people have made or well-respected people in the industry have made have been largely right. They've just been like pretty late.
It's like been right on like the direction, just like the timing.
Yeah, like the wall of maturities, banks are working things out. Interest rates are going to come down. Yeah, maybe, probably. But
last year, everyone was certain. Remember, last year everyone interest rates are going to be lower.
Yeah.
In 2025, survive till 2025.
Exactly. All that stuff is just like, seems like it will happen. They're starting to happen, but it's just like getting pushed. So I'm not expecting any kind of like, cap rate compression at 26 or really anything like that. So
yeah, everyone just needs to be patient.
Yeah,
just
exactly.
Strap in.
Exactly. For a long kind of, not slog, but I think it'll generally slowly get better. Some of these, supply is going to get absorbed. Some growth is going to, come in. We're already seeing strong growth in Indy. So that's probably what I'd predict.
Yeah. So maybe moving away from multifamily a little bit, I know you focus a lot on kind of personal finance stuff, just for yourself and just, just kind of interest, of yours. Anything, I guess, new that you're doing kind of personally on the personal finance, front that, open to sharing? Any tips and tricks?
Tips and tricks. One thing on like the public equity side that I'm growing more aware of, I guess more concerned about, is like how, heavy the S&P or just the stock market in general is controlled by 7 major companies.
Yeah.
And like the stock market has done so well in the past 2.5 years since 2022's like downturn. And so just recognizing how a few number of companies contribute to everything, like the spending in AI, data centers, chips, everything in our economy is just like a growing concern for me, I would say. And so, recently I've invested in some stuff that is the S&P 500, excluding the Mag 7.
Yeah.
Just to try to right size that a little bit and get away from tech a little bit.
Yeah. I think you're mentioning that to me this week. I think that makes a lot of sense.
Yeah.
It's smart. Can you see a downturn just because things have been going kind of so hot, almost like too good of a picture, especially when things are slowing down? Again, a lot of the growth has been with the anticipation that interest rates are going to come down.
Yeah.
And that'll kind of smooth things over and we're going to be able to kind of like keep things going. But can you, I guess, it wouldn't shock me to see not like a crash or anything, but a little bit of a pullback and a slight correction.
Yeah.
Just with the growth we've seen this year in the public equities markets.
Yeah, you talk about valuations of real estate, valuations of some of the Mag 7.
Yeah.
It's just like crazy.
Yeah. Oracle hit $1 trillion valuation yesterday.
Saw that. Larry Ellison's the
richest guy in the world now.
I saw that. I could see one bad headline or one Apple coming out with whatever, some kind of negative.
Yeah, well, we've talked about, I think, with AI. If there's, any kind of
in spending, Zuckerberg's like, we're not going to spend as much as we thought we did.
Yeah, we're not getting any productivity gains.
Yeah, and then just boom, 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 and just drag everything down.
Yeah.
But
do you see Tucker Carlson interview with Sam Altman about seeing if Sam Altman
not yet. I heard about this.
Murdered his coworker.
No, I haven't listened to it yet, but I will.
It's a little it's interesting.
Yeah, the AI stuff is so interesting, and I use it every day now.
Yeah,
like more and more so. It's just like everything gets a little overhyped when it first comes out. I think, and like long term, I think it is going to be great and amazing, but I just think it's going to take longer than everyone thinks it is.
How are you using AI in every day?
Well, I've been talking to Grok in my car.
Just because you need a friend?
Yeah, just because I need a friend to be like, hey, like, what do you think I should do this weekend? And what kind of cool events are going on? No, just like general questions, usually like, finance questions or I don't know. Just general questions. But they implemented Grok in the Tesla so I can like press a button and like, it's pretty good.
Yeah.
It's.
Do you like Grok? I guess compare Grok to ChatGPT, OpenAI.
I use ChatGPT for all the deep research stuff, and now we have like the pro version. And so I like that more for writing things. Hey, what do you think of this idea? And like help me organize it and stuff. Grok, I've just been using more audibly,
Yeah.
and talking into it and having it talk back to me.
Have you done that on the ChatGPT feature?
Not as much.
Yeah.
No, I usually just, it's basically my search engine now. It's like ChatGPT. I use it kind of like I used to use Google.
Yeah.
Yeah.
The only time I use Google now is if I'm specifically going to like a site, or like I need to search like one. Like I'm looking for really just one thing. Even that I could still use ChatGPT.
I usually like you're trying to go to CNBC or something. I would just like
type CNBC. Well,
I would just type CNBC. I wouldn't even like.
What do you mean, like into your browser bar?
Yeah.
Yeah, that's what I do.
Yeah.
But then default Google pops up.
I guess,
but,
I never go to Google like searching.
Google dot.
No.
You don't.
It used to be like my home screen.
http //www.google.com.
Finally, now I can use the internet. No.
Yeah.
But it's getting. I mean, some of the stuff that we've done recently. I don't know if we just say this, but I dropped in like all of our quarterly reports or like our printed data, just like all the columns and rows and stuff, and I'd be like, hey, give me like 1 or 2 paragraphs. Like, what are you pulling from this? And it takes like 15 minutes or whatever to do a deep research, but then it gives me like 1 or 2 paragraphs. That's probably in better framing than that would take me 1 or 2 hours.
Yeah. Yeah.
And like, we're still having meetings on all of the data and like, we need to focus on this and whatever renewals, delinquency, but
it's amazing how close. I did a similar thing, just like aggregating a lot of asset. It was like after an asset management meeting, I was aggregating a lot of just like the different reports that we look at.
Yeah.
Just kind of like highlighting just, different risks, different summaries. And it was pretty similar to the conversations reports that we had. Yeah. And honestly, it identified a couple things that, we hadn't defined in the same way.
Yeah. I have a question.
Yeah.
What do you think, where are you on the side of AI causing job dislocation, or is it just going to enhance people to do more work?
I think it's gonna do both.
Do both.
I think it's gonna make people much more productive. There will definitely be jobs that are eliminated because payroll is expensive. People are expensive,
right?
And if you can get the same things done with an AI tool, or you can get one person to basically do the work of 1.5 persons, and that delays maybe necessarily needing another person. I don't know if people are just going to go through and just lay off whole departments, because I think that it needs to be really proven out over time,
which makes it a little bit more sustainable. If it kind of happens slowly over time, and maybe people lose their jobs very slowly and get different jobs or whatever, then that's okay. But if a new model comes out, that's just.
And I just think there's been enough like examples in history of where there's been development of the internal combustion engine or any piece of technology that has eliminated whole industries or jobs, but the economy has adapted, created different jobs, and in general, the vast amount of more wealth for society as a whole was created from that technology.
Right.
And I just see I think AI I think it is going to be a major productivity enhancer, which allows us. I mean, it could be. Can't really count on this, but if we have so much debt in this country.
I was going to say,
with 30.
You want a Hail Mary on AI?
It's almost like it's. It shouldn't be. The scary thing is that it provides an excuse to continue spending money, because we actually need some hard truths to be like, we actually have to stop spending as much money as we're spending and get serious about fiscal responsibility. But being real in the fact that, we're not going to reform entitlements, we're not going to reform military spending.
Yeah.
The only way to continue doing that the way we are is to increase productivity. Well, that too.
Yeah.
You need to get revenue in, but if you can create in order to not create inflation, you either have to tax people or you're going to have to print money. And we don't want to tax people, so we're going to print more money.
Right.
And so the only way that we'll be able to avoid just, return of inflation is to become much more productive, and for technology to have an outweighed deflationary effect because of technology.
Right.
And it makes us more productive. We can do more with less. I mean, that was part of the phenomenon between, GFC and COVID is, we printed a ton of money. We were doing quantitative easing. Interest rates were low. Governments were spending a ton of money, but we had this big technology boom due to, the internet and being smarter and apps and Web 2.0 and all of that. So I don't know.
I'm kind of in that camp as well. Like there will be some people that lose, or like significant amount of people, but I think it's gonna be slow, and there's gonna be, the economy's gonna adapt to it. I just hope it doesn't like, oh, they release a legal AI and now all the attorneys are gone or something. It's like,
Aaron, we love you.
Yeah.
But
yeah.
But I mean, a lot of legal stuff. I mean, I need a document drafted, or written.
Change this.
Like, it can do a pretty good job.
It does a really good job.
Yeah.
And it's just one example, though. I mean,
but then, I mean, if you think about it, it's like, is the highest and best use of an attorney drafting a document? Like, definitely not.
Right.
It's because their problem solving abilities and their knowledge of the law and their creativity around the law to be able to make decisions and to navigate problems and find solutions. And then, papering it up isn't what you want to pay an attorney for. Like, I had to spend I'm paid 2 hours to write something up. And sure, they can say it's a paralegal or whoever.
Yeah.
But I think it allows, in an ideal world, it allows all of us to be focused on the things that are truly highest and best use, the things we want to work on.
Right.
What we would like humans to be doing with their time, rather than just working on widgets or administrative tasks, which are essential to being done, but they're not exactly super fulfilling.
Yeah.
And so if we can live and again, getting to any kind of world where we're not post scarcity, but we can tackle scarcity. I mean, that's the only way to get there, is by being able to automate things. I mean, 100 total capitalist. But like, the whole idea, you look at, Marx's theory and, communism was, it's like, we're eventually going to have all the technology that's going to automate everything for humanity. We're going to live in this great world. And, but all, we're all going to, people are going to own the means of production and all of that. We're going to take it from all the, the private landlords.
Right.
But I don't think we need to do any of that to be able to, get to maybe a post scarcity society where there is an overabundance of wealth, and that it's not that there are, the solution is not to get rid of the rich people. It's make all the poor people
more
rich.
Effective, and wealthy. Yeah.
Well, like I don't know the statistic off the top of my head, and so if this is factually incorrect, let me know. But there's been a decline. You hear all the middle class is shrinking.
Yeah.
That the lower income classes also shrunk. What the income class that has grown?
The upper class.
The upper class.
Yeah.
And it's not just that the upper class has more money. They absolutely do. But there's more people in upper class.
Right.
Isn't that the whole goal?
What you want for everybody. Yeah. Move up.
Why can't we, let's get everyone, and there's always going to be a strata.
Yeah.
But the fact that everyone has an iPhone.
Yeah.
I think is boding pretty well
right.
for capitalism.
Right.
I don't know.
Yeah.
Well, Blake, anything else talked about flats, we talked about markets. Thanks for being on. Anything else? We're wrapping up a $25 million raise. We haven't closed. So, we've got a capital call that's coming up. Planned capital call to close on the deal. Call for capital.
Put it separately. Yeah.
Anything to reflect on? I guess, we didn't know where the $25 million was going to come from when we put the deal under contract.
Mm-hmm.
When I sent over our earnest money, our deposit, I didn't know where we were going to raise the $25 million from. We had a lot of ideas.
Yeah.
We are constantly working. If we don't have a deal, we do this podcast, we're having conversations with investors. It's not like we sit on our hands until we have a deal.
Right.
But we had to make a lot of new relationships. What
the good thing is, like, we did it and it was hard, but it should be. It's like, it's $25 million. It's like, shouldn't be that easy.
No.
Yeah. I mean, maybe it's easier for some people that, know a billionaire and they're like, yeah, I'll write a $25 million check. But like, I don't think it should be that easy. It should be hard. And it was hard. And there was, 200 calls or whatever, 200 meetings.
It's always a combination. I'm asking about, I guess the key to the success of how we're able to do that, it's the deal. It's the, our track record, I guess.
It's you managing our emotions when we're like, oh, this is too hard or this is too easy. It's like, no, it's not. No, I don't know.
Well, there were a handful of times Blake would come to my office and be like, he's like, I have no idea how we're going to do this.
Yeah.
He's like, I don't know where it's going to come from. And I had to look at Blake and I'd be like, well, we're going to figure it out.
Yeah.
One, you have to trust the process.
Yeah.
Because we've done it enough times now. And again, in an ideal world, yeah, we knew where all the money was going to come from right before.
Yeah.
But we've never not been able to raise 100% of the capital to close a deal. Now, again, we went from the first deal, like I did, it was like a $2.2 million raise. We jumped to like a $12 million raise in the same year. Right. It was the same thing. Zero idea how we were going to raise that money.
Yeah.
And the seller was like, I don't even think these guys can raise the money. They wanted to pull out of the contract. And I had to say, like, look, I'll let you know in 2 weeks.
Yeah.
If we can't do it, but give me the 2 weeks. Let me have a little bit of time, a little bit of momentum. And I do think, being optimistic is really important. And remember we had the monthly meeting right before we went under contract on flats.
Yeah.
And again, I'm not like,
it's one of those things that's like very easily said and much more difficult to implement on a day-to-day basis when you have, however many meetings. But you did a good job of that.
We willed it. I mean, again, I said, I was like, we're going to will $25 million into existence right now. And again, that wasn't what we did, but we did. We also did that.
Yeah. It was hard and it was fun. And I think it'll be a good deal for everybody.
Yeah.
And so,
looking forward to it. Just a disclaimer, all of our deals are only open to accredited investors. Obviously this is not an offer to invest. We're fully subscribed. You can't even invest if you wanted to.
Yeah.
But it is going to be a good deal. I'm excited about it. Yeah.
It'll be great.
Well, if you've been watching this episode of The Grow Report, I really appreciate it. It's been a special live version of The Grow Report. If you haven't subscribed, make sure you do subscribe. And we put out an awesome newsletter that comes out every Thursday, typically at 8:30. We put out our 279th edition of our Thursday edition this last week.
Wow.
So it's been a lot of newsletters, a lot of Thursdays. That email's been going out. And we put a lot of time into it, a lot of good articles. It allows you to just stay on top of all the latest research reports, articles. And frankly, again, obviously we love our prospective investors to look at it. And the people who look at it the most are industry professionals, very high level industry professionals, and other industry publications. When I was going through who's like clicking on the email address, I'm like, these guys are getting their information from us. I mean, it's like, I'm not going to name the name, but it's like pretty high level, like, business publications that are reading the Gray Report to get their leads.
Right.
And part of it is, I mean, if we are often, and I'm bragging a little bit for the Gray Report, we're often 3 weeks ahead of some other market commentary.
Yeah.
And we were talking about all of this, the data discrepancies and CPI. We've been talking about that for a year at least. And now it's in the headlines.
Yeah.
And so part of it, we're on top. We're just doing this day by day in the newsletter, in the podcast. It gives us an edge. We're doing it. We're doing it because it's important for our business to understand.
Yeah.
Like, why not do it together with the rest of the industry and our investors and make it a win-win?
Yeah, I feel like it's been that case from a number of different topics where we've been a little bit ahead of, where we're hearing it from the general media. The debt maturities for GPs, and we heard, I don't know, what was that? We started talking about that like 23.
Early 2023, we put out our first research report. It's finally coming. And there are times people are like, oh, that thing that you said was going to happen didn't happen. And it's like, well, we said that there was a variety of outcomes.
Yeah.
And the situation, was a situation, just the can's been kicked down the road.
Yeah,
the problem hasn't gone away.
But I'm hearing more deals that are going back to the bank.
We saw that those deals like the foreclosure 5.
Yeah.
That's becoming more common. You didn't used to see foreclosures everywhere.
Exactly.
And if you look at the schedule of loan maturities, specifically in multifamily, we're still at a period of kind of high pressure and high risk.
Yeah.
It's going to go throughout the rest of 2025, really throughout the first half of 2026.
Yeah.
A ton of loans are going to be matured. We know people are trying to refinance deals. They're having to bring preferred equity on to get a lot of those deals closed because they're having to do cash and refis.
Yes.
But there's a reason. Refinance volume is loan origination and refinance volume is way up, but transaction volumes are down.
Yep.
So it's all refis.
Yep.
And there's all this pref going everywhere and all these capital calls. And so they're not being sold. They're, the can's being kicked down the road further and further.
Yep.
So it's happening. Just how that all, what I don't think is going to happen, which we've never really called for, is like, it all comes to a head.
No.
And there's just a dump of inventory.
No.
It's kind of a, it's smooth. The crisis has been smoothed over to a
exactly.
very large degree. All right. Well, again, subscribe to the Great Capital YouTube channel. Sign up for the newsletter at greatcapitalllc.com. And if you are a multifamily investor who is an accredited investor, go on the Great Capital website and schedule a meeting with us, schedule a meeting with Blake or Griffin. We'll have a conversation with you. And let's do some good deals. Thanks for watching. Make some good decisions. Let's all be safe out there.